Smart money concepts explained. Trade like a market maker. Most traders lose money because they trade against the people who move the market. They buy tops, sell bottoms, and get stopped out exactly where smart money enters. If you've ever wondered, how do market makers actually trade and how can I trade like them, this lesson will change how you see charts forever. Today, you'll learn step by step how to trade like a market maker using smart money concepts, understanding liquidity, structure, and manipulation so you can stop being the hunted and start trading with the institutions. Step 1. Understand what smart money really is. Smart money simply means institutional capital, hedge funds, banks, and liquidity providers who have the power to move price. They don't buy after the crowd buys. They create the illusion of a move, trigger retail orders, and then move price in the opposite direction to fill their positions at better prices. To trade like them, you must understand how price is engineered, not just what indicators say. Smart money concepts teach you how to read the market's true intentions, not the traps. Step 2. Market structure, the DNA of smart money. Everything starts with market structure. Market makers move price in 3 stages: accumulation, manipulation, and distribution. Accumulation: price moves sideways after a downtrend. Institutions quietly buy from retail sellers. Manipulation: a sudden fake move breaks support, triggering stop losses while smart money finishes buying. Distribution: once positions are built, price rallies, targeting liquidity above previous highs. Learn to recognize these 3 phases on the chart. Where the crowd sees chaos, the market maker sees opportunity. Step 3. Liquidity, the fuel behind every move. Smart money trades for one reason: liquidity. Liquidity means available orders, buyers and sellers they can trade against. Market makers hunt liquidity in 2 ways: equal highs and lows, where retail traders place stop losses, and round numbers and obvious levels, because emotion gathers there. When you see price spike above resistance and reverse sharply, that's not randomness, that's a liquidity grab. To trade like a market maker, always ask who's trapped, who's providing liquidity for the next move. Step 4. The break of structure and change of character. These 2 smart money concepts confirm when control shifts from retail to institutional hands. Break of structure confirms continuation of trend. Example: price breaks a previous high. Institutions are still buying. Change of character signals potential reversal. Example: price breaks a previous low in an uptrend, momentum shifts. Trading becomes simple once you learn to spot these shifts. Don't chase price, wait for structure to break, pull back, and re-enter with smart money. Step 5. Identify institutional order blocks. An order block is the last bullish or bearish candle before a major move. That's where institutions executed large orders. To trade like a market maker, identify the last opposite-colored candle before a strong impulsive move. Mark it as your order block zone. Wait for price to return to that zone. This is where institutions reload. When price revisits that area with liquidity sweep and rejection, that's your low-risk, high-probability entry. Step 6. The power of liquidity grabs and fakeouts. Market makers don't trade against retail, they use retail. They know where traders place stop losses, so they trigger them to build their own positions. Example: retail sees a double top and shorts early. Price spikes above the top, takes out their stops, and then reverses. That's the liquidity grab. When you see false breakouts near structure, that's often the market maker collecting orders before the real move begins. Learn to anticipate fakeouts, not fear them. Step 7. Entry strategy using smart money concepts. Here's a simple 3-step entry framework. Wait for liquidity sweep. Price takes out previous highs or lows. Look for CHOCH, a clear break in structure showing reversal intent. Enter on pullback. Wait for price to retest the order block or fair value gap. Set stop loss just beyond liquidity zone and aim for 1 to 3 risk to reward outcome. This aligns you with institutional flow, not against it. Step 8. Fair value gaps, the market's imbalance zones. A fair value gap appears when price moves so fast it leaves a gap between candles. This shows imbalance, an area where institutions will likely rebalance price later. These zones act as magnets. Price tends to return to fill them before continuing. Combine FVGs with order blocks and liquidity sweeps for powerful confluence. When smart money leaves imbalance, it always comes back to clean it up. Step 9. Manage risk like a market maker. Institutions don't guess, they control risk mathematically. To trade like them, follow these rules. Risk only 1 to 2% of total capital per trade. Use liquidity levels for stop placement, not arbitrary numbers. Target imbalances or opposing order blocks for exits. If a setup doesn't align with your plan, don't trade it. Smart money trades fewer setups but executes them flawlessly. Quality over quantity is how they stay consistently profitable. Final thoughts. Trading like a market maker isn't about predicting, it's about understanding. You're learning to think in terms of liquidity, structure, and manipulation, not indicators or luck. Once you align with smart money flow, every chart starts to make sense. You'll stop chasing price and start trading from logic, not emotion. This is Online Trading Hub, helping beginner and struggling traders build clarity, confidence, and consistency, one concept at a time.